How's it going? Welcome to the live. Let's make sure we got the right audio here. All right, we should be good to go. All right, welcome everybody. Today we're talking about adapting or failing. Real estate market has changed. We're gonna give everybody a couple minutes to join in, and we'll get started. Today we're gonna be talking about how you should have already adapted to the change in the real estate market. But if not, it's not too late. How you should adapt as a real estate investor, as a wholesaler, as a flipper, as someone out there bird dogging looking for deals. We're going to talk about adapting or failing. How you need to change with this current real estate market. Where's everybody tuning in from? Where you guys at? All right, so we got YouTube, Facebook, LinkedIn. It's pretty cool. We can go live on Twitter now. Does it do the video on Twitter? Where's Instagram? Instagram's here.
So it's how to create opportunities.
How to create opportunities in real estate. But you do need to adapt or fail. So we're going to be talking about that today. Where's everybody tuning in from? Instagram, where you at? TikTok, where you at? I want some collaboration here. All right, so the real estate market has changed. If you have been investing in real estate for the previous 5 years, it was a great market to invest in deals and gain a lot of appreciation. We were experiencing the lowest interest rates in history. Can you hear me? Let's see where interest rates are at today. You can hear me all right? All right, so we had the lowest interest rates in history, and they've since risen. So when they rose, the cost of debt rose. And when the cost of debt rose, the prices of cash flowing properties fell, because now it costs you a lot more money to hold on to these properties and to make them cash flow, due to the fact that all your money is going to debt and operating expenses. So in order to make that investment make sense, you need lower prices. Round Rock, all right. For commercial properties, the cap rates have risen along with the rise in interest rates. And if you're buying single family homes, depending on what market you're in, but here in Austin, it was hard to make those cash flow in general. But you were buying and you were getting some good appreciation. But now that appreciation has ceased, you're not getting as much appreciation. There's a lot less room for error, and so you have to be much wiser and practice a lot more discipline than you had to in 2020 and 2021. So I mean, for single family homes, if you're buying them to hold on to them, single family rentals, the idea in a hot market such as Austin was to try and figure out a way that you could buy it undervalued. So you never want to buy at market value. You always wanted to buy below market value. But you wanted to try and get some good debt on it to make sure that it's still cash flowed, or at least broke even. Because in Austin or other hot markets around the United States, I'm sure, breaking even was a good goal to hit. Because you're going to make all your money on appreciation. And even if you lost $2,000 a year in cash flow on a single family rental, if you gained 150 grand in equity, it wasn't that big of a deal. But now you're no longer gaining that equity. You're no longer getting that appreciation that you once were, as interest rates were as low as they were. And now the cost of debt is a lot more expensive. So due to that, you need to change the way that you buy. So, with single family rentals, you were gaining a lot of appreciation with these in 2020, 2021. From June of 2020 to June of 2021, there's like a 42% year over year price growth for single family homes in Austin. But that ain't happening anymore. Matter of fact, it's starting to come down. So either that, or we're gonna, flatten out, and you're just not going to gain as much appreciation as you used to. Also, too, due to the rise in interest rates, I mean, if you want to get 4% return, you could just go invest in Apple's new savings account that they released. You go invest in other things that are paying high interest rate returns.
Someone's from Lebanon.
From Lebanon. All right, welcome. So here is, and this is on the investing side. And so now you're no longer getting this appreciation, and your property, depending on what you paid for it, the price is likely going to be decreasing. And if you paid too much for it, you might be underwater right now. I mean, there's plenty of people that bought in the middle of 2022 who paid way too much for their properties, and they are definitely underwater right now. They may have a good interest rate, and if they do, they're probably going to want to hold on to it for a little bit and try and ride this out, but it could be a long time before it turns back up. I was talking to a seller on Friday who paid like $375 for his property in Leander, Texas, which is a suburb of Austin. The property is no longer worth $375. It's worth about $350. He owes about $338 on it, and he wants to sell it. His mortgage, property taxes, insurance, principal, and interest. His mortgage payment plus HOA is somewhere around like $2,500 a month, and currently he's trying to rent it out for $2,000 a month. So he's going to lose $6,000 a year if everything goes perfectly. If he's not paying a property manager, if he doesn't have to do anything for maintenance, if nothing goes wrong, he's going to lose $500 a month, $6,000 a year in cash flow. And this is like best case scenario for him. So he could hold on to this property, try and rent it out and minimize his losses and wait until the market turns back up. Or which is the route that we were going down it with him. He's got like a 4% interest rate. His payment is low, comparatively speaking, to what if someone were to go get a new mortgage on it today. If they bought it at $350, which is what it's worth now, his payment is comparatively low if someone were to go get a new mortgage on it today at $350. But we wanted to see if he would consider letting us take over his mortgage payment. So we would come in, basically take the property for free. We wouldn't put anything down. We would just buy it for the balance on the loan. We would hold the deed, so we'd be the owners of it. And we would leave his current mortgage in place, and we would start making payments on behalf of him for these mortgage payments. And what we could do is take that property. We could sell it at $350, $360, maybe $370, and wrap it and sell it to somebody else at, let's say, an 8% interest rate. And we could collect cash flow every single month. We collect the difference between $338 and whatever we sell it for. We'd get a good down payment from the new buyer, and they would make seller finance payments to us moving forward, and we would keep the cash flow. So that's one way to adapt with this market, is go and help sellers who are in an unfortunate situation where they want to sell, they don't need the property anymore for whatever reason. They've got a good interest rate on the property, and they need to get out from underneath it. And you can buy it from them via subject to, take over their payments. You can get in there with no money, which is what we were going to do in the case with this guy. But he wants to try and rent it out. So he's going to try and rent it out. He's going to lose $500 a month, $6,000 a year, and he wants to wait it out until the market turns back up, which will happen. We don't know when it'll happen. Could happen next year, could happen 10 years from now, could happen 5 years from now. But he's going to have to eat that loss every single month until it does turn back up, if he wants to continue to stick it out. So here's what I would suggest. Here's one thing that hasn't changed. Well, Yeah, one thing that hasn't changed, number one, is never say it. What is it, Kat?
Never ever pay market value.
Never buy at market value. So buy below market value. If you think conservatively the property is worth 350, right now today, try and buy it at 300. And next month or 6 months from now, it may not be worth 350 anymore. Prices are on the decline. One thing they're not is on the incline. So never buy at market value. You need to protect yourself because you don't want to be underwater.
Someone did ask,
Got a question.
how do you know the good amount to pay for the home?
Second thing is you right now you're not going to buy. Do not buy for appreciation. You want cash flow. You need one thing you don't want is you don't want to lose money every single month on cash flow and your property to be decreasing in value as well. You don't want to lose twice. So your property may decrease in value, but that's okay. You're in this for the long run. If you're a long-term buy and hold real estate investor, then hopefully you never want to sell these unless you're trading into a better asset. But it will turn back up, but you need to be in it for the long run. And so while you're in it for the long run, you're waiting for prices to get back on the incline. You don't want to lose cash flow as well. So you want to have properties that can sustain themselves. You want to have properties that that pay you every single month. What?
Do you know anything about international real estate?
Not necessarily, but real estate fundamentals are the same, right? So these principles apply no matter where you want to buy it. You never want to buy at market value. You want cash flow, and you want everything else that I'm about to go over as well. You don't want to lose money. So the real estate game is the same no matter where you're playing it. It's the same rules. Doesn't matter if you're buying this in Arkansas. Doesn't matter if you're buying this in Austin, Texas, in Italy, in Mexico, in Germany. Your goal with real estate investing is to make money, and another one of your goals is to not lose money. So these will be the same rules. All right, so never buy at market value. Do not buy for appreciation. You need cash flow. And three, right now, is you need to get creative. Talked about this a lot, pretty much every live that we have, but we're going to talk about it again. You need to get creative. So you need to figure out ways to have creative deals with these sellers, because if they're underwater, you're not going to be able to, unless they're just willing to take the loss, which a lot of them either A, can't, or B, they for sure don't want to. And they're going to take some sort of loss, but by getting creative, you can minimize the type of loss that they're taking, and it still be a win-win for you as well. And this applies for wholesalers too. I mean, wholesalers, comment if you see anything different, but people are not wanting to flip properties like they were last couple of years. It's not a great time to flip properties. We don't know what prices are going to look like in 3 months. And unless this is just an absolute home run deal, wholesalers are probably having a hard time pushing properties that would be good flips. And even if they're pushing them as rentals, your strategies that you were utilizing over the last 3 to 5 years are no longer going to work because people don't want to buy them. We reach out to our buyers list often, and we circled back and started calling not too long ago to some buyers we hadn't talked to in a while. And a lot of the buyers that we spoke to said, no, I'm no longer investing in real estate. I don't know if they were even ever investing in real estate. You go on Facebook right now, join all these Facebook groups, and everybody in there is a real estate investor. But it's not as easy to make money investing in real estate right now as it was, the past few years. All you had to do is go buy a house, and then next month it increased, 10% value, or just list it on the market in a place like Austin, Texas, and you'd have 100 offers offering way more than ask price. But it's not happening like that anymore, and it's not as easy to make money like that anymore. So a lot of people have left the market, or they've dropped this dream. Yeah, it's kind of hot. They've dropped this dream of investing in real estate when they probably didn't have the right expectations to begin with, and they probably didn't have the right strategy. They probably didn't have the discipline. They probably didn't have everything needed to make this work and make this successful. So whether you're a wholesaler, whether you are looking to what
Someone says if you could give an example of the third part.
Yeah, I'm about to. Getting creative. Yep, that's exactly what we're about to do. All right, so what are some ways that you can practice creativity? And this applies for, thank you guys for participating today. We appreciate it. So this applies whether you're looking to go out and buy deals yourself. This applies whether you are a wholesaler. You should absolutely have these tools and this knowledge and these exit strategies in your tool belt to be able to pull them out, because you're going to need it. And the way that you have been negotiating over the last few years, you're no longer negotiating that way. And so you also didn't need to. I mean, you could go out, back then you could go out and get an interest rate at 4%, 3.75%. So there was really no point in working seller finance deals and for interest rate alone, unless the seller is willing to give you an interest rate lower than the bank would give you, if you're able to go and get a bank loan at those lower rates. So what are some ways to practice creativity? So one way is seller financing. These are all some form of seller finance wrap, seller financing, sub 2. You do lease purchase contracts. These are all creative ways to get deals done to make the payments make sense. So if you find a seller, let's start with seller financing. I've discussed this many times, but we're going to keep discussing it because it's a great way to get deals done. So I call Kat, or Kat reaches out to me. She says she wants to sell her property, says that she needs to sell it. She's owned it for a while, and she wants to get X price for it. Well, first question I always ask Kat is how she came up with that price. Is this because your neighbor told you that's what it was worth? Did you run comps yourself through the MLS? You looking at Zillow? Like, is this your tax assessed value? What are you smiling for?
Most people say so.
Zillow, where's this value coming from? It's good to know, because sometimes they don't know. Sometimes they just tell you, well, that's just my price. That's what I want to get. That's what I would have to sell for. And so you're having these conversations. You're working through the motivation. You're trying to figure out what the story is. Why do they want to sell? Why do they need to sell? What do they need this money for? What are they going to do with this money once they get it? Do they really need all this money right now, or do they just need a little bit? And so you're trying to identify this motivation. And if they do want to sell, why do they not just want to list it on the market? Like, why, we're realtors, we're licensed brokers. We can just list it for you. If you want to sell at the highest price possible, and you want every single potential buyer to see this to see this house so that the market can get you a market price for it, why do you not want to just list it? We can list it for you right now. We come over, take some pictures. You probably need to update the house a little bit to get top market value. You probably need to declutter. We're gonna have to put a sign in the front yard. We're gonna host some open houses. We're gonna be scheduling appointments with buyers and real estate agents to come view your property. And a lot of times listing it on the market is not what they want to do. And they'll quickly tell you, but I always ask them first, well, why don't we just list it? If you want this unreasonable price and if you want to get as much money as you possibly can for it, then let's just go ahead, list the property. That's where you're going to get that. And then they'll quickly tell you, why or why not that won't work. And a lot of times it won't work. If they do want to list it, then great. You just, as an entrepreneur, you've got that exit strategy and that tool in your tool belt. And you just list the property for them, get paid your commission, and move on. But a lot of times it won't work. So for whatever reason, I've had one lady tell me that the main reason she didn't want to list her property is because she's got two, I don't remember if they're German Shepherds or something. She's got two big dogs, and she will not put them in their kennels to show the properties. She would not cage the dogs for buyer appointments. So little things like that deter people from wanting to list their house. It's also kind of a pain. I mean, you have to do so much to the property. It's got to be perfect. You're going to have appraisals. You're going to have, a bunch of showings. You're going to have open houses. It's this whole process. And yes, it is where you will likely get the most money for your property. It's also a big pain, and a lot of people don't want to deal with it. And if they could sell it without having to list it, they probably would rather go that route and avoid the headache of listing their property. So then we start asking them, okay, well, you called me because you wanted a cash offer. Well, I can't pay you what you want for the property cash. I would make no money. We're investors. We're investors. It's the reason you called. So you got to understand that we have to be able to make money somehow. And if we buy this property, we're going to have to fix it up. We're going to have to put all this money into it. We're going to have mortgage payments. We're going to have taxes, insurance, utilities, all these things that we're going to have to pay for it. It's going to cost us all this money. And then to hopefully sell it on the back end at some higher price, we still need to have a margin built in for us to make a profit on it. So if you want us to buy it cash, which we can, or one of our partners, one of our investors can buy it cash, we have to be at this price. And it's usually a price that they don't want to sell at for whatever reason. Okay, so you don't want to list it. You don't want us to buy it cash for the cash number. And I also tell them, look, this price that you want, there is absolutely no one that you're going to call that will buy this house for you in its current condition cash and close in 14 days. It won't happen. You can call every single cash buyer around here, and I guarantee you not one of them will pay you cash for your property at this price in its current condition, because they all would lose money. So once we get those expectations set straight, I ask them, okay, well, we're not listing it. You don't like our cash offer. What we can do is, we can explore some of these other options. We can buy this from you via seller financing. Do you have a mortgage on it? How much do you owe? What's your payment? What are you going to do with this money when you do close on it? Do you really need $350,000 right now, or do you just need $20,000 to go do whatever you want to do with it? Put a new down payment on some land or whatever. After you learn the story, after you learn the motivation, then you can start providing some creative solutions that will help them achieve that goal. And one of which is seller financing. And so this is what I explained to them. Look, we can buy this from you via seller financing, but we may be able to pay your price. However, I need the other terms to work for us in the seller financing deal. So I need the down payment to make sense. I need a low enough monthly mortgage payment so that we can make cash flow on the property. And then I start running them through the numbers and explaining how it'll work. So I'll tell them, What do you think it'll rent out for? 2,000. Okay, great. So that's going to be 24,000. Yeah, $24,000 a year in rental income. We're going to have to pay a property manager. We're not going to manage this ourselves. So they're going to take 7% of the monthly rents and management fees. So that's going to leave me with about $22,000. What'd you say the property taxes are? 5,400. Okay, so I'm gonna have to pay those. You're gonna require that I get insurance on the property. That's gonna cost me about $2,500. All right. I'm probably gonna have some maintenance that I have to do. You know, tenants are always calling for maintenance requests, whether it's the blinds or the lights or the sink or the toilet or whatever it is. There's gonna be some maintenance issues that I'm gonna have to pay for. So would you agree that $1,500 a year is a pretty good estimate on the conservative side for how much I'll have to spend? Yeah. Okay. Cool. So minus 1,500, that puts us at 12,600. And so if I, give you, let's say, a $10,000 down payment, you said that I had to put $30,000 into the property to update it. So that's $40,000 that I'm gonna have to put into this property due to the down payment, also fixing it up. So I want to get at least a 10% return on that 40 grand. So 10% of 40 grand is $4,000 in monthly cash flow. Annual cash flow. So I need to subtract that. And that puts our annual debt payments at max at about $8,600 a year. So that means the most I can pay is about $700 a month in our mortgage payment. Would that work for you? And then if it does, then great. If it doesn't, we start negotiating those terms a little bit more. But that's how you can take a situation that wouldn't otherwise work to buy cash or whatever as a rental and make it work by structuring seller finance terms. You can do the same with a lease purchase contract. Same idea, essentially. You're paying rent with the option to purchase. And then subject to is where, let's say, like I mentioned earlier in that example, the guy who bought his house for $375, it's now worth $350. He's got a $338,000 balance on the loan. He's got a 4% interest rate with PITI. His principal with his PITI payments are about $2,200 a month, which is pretty good. Again, comparatively, if someone were to buy it at today's interest rates and at $350. And so what we would do in that scenario is come in and just take over his payments. So we would buy it at $338, his balance. We would probably pay some closing costs, some attorney fees for drafting everything up, but it wouldn't be much, maybe a few thousand at closing. And then moving forward, we would start making his mortgage payments for him. So he would be able to just walk away. He wouldn't make anything. He would actually lose money because he bought it for $375. He owes $338. That means he's got that equity in there that he's going to just say goodbye to. However, he is able to just walk away from the property. We'll buy it. We won't pay him anything extra. It's possible that we could if there was enough equity in there. But we'll just take over his payments. The mortgage will stay in his name, but we own the house. So we would take the deed, we buy it for $338, and we would start making those $2,200 monthly mortgage payments moving forward. Now, we wouldn't want to keep that specific property because we would just lose money on it, listing it, as having it as a rental. But what we could do is take that $338 balance, and we could go and wrap it and seller finance it to somebody else. I could go to Kat and say, hey, Kat, look, I know you're having trouble getting approved for a loan from the bank, but I've got a very nice property. It was built a few years ago. I'll sell it to you for $380,000. I want you to give me $40,000 down, and I'll seller finance it to you at an 8% interest rate. So your payments are going to be $2,900 a month to me, you get this property. You don't have to go get approved for a loan, none of that stuff. And it's now yours. And so what we could do there, if her payments were $2,900 or whatever I just said, and our payments are $2,200, we would get to keep that $700 a month in cash flow, and we'd have a $40,000 down payment. If Kat ever defaulted on the loan, we would go foreclose on the property. We'd take it back. We'd kick Kat out, and we'd go find a new buyer for it, and we get to keep that down payment. So that's your security as a seller finance seller, is that down payment that you got. And we would get to keep all that money. I mean, $700 a month in cash flow from a property that you no longer own is pretty good. 700 times 12, $8,400 a year for a property that costs you a few $1,000s in closing costs to buy. And anything that goes wrong with the property, Kat's going to be responsible for fixing. Roof, big hailstorm comes through Round Rock and Austin, and roof needs to be replaced. It's Kat's responsibility. Foundation needs repairing, Kat's responsibility. Water heater goes out, stove needs to be replaced, Kat's responsibility. It's her house, she owns it, so she's responsible for all the maintenance. And it's a great way to take deals that everybody else looked at and said, this isn't a deal, seller's screwed, they're underwater, and turn it into a great deal for the seller, for you, and for the end buyer, because the end buyer is having trouble being able to get and afford a house with the traditional way to buy them. But if you're able to provide a solution to seller and end buyer, you can just collect that difference in cash flow every single month, and also sell properties for way more than they're actually worth, because the seller finance buyers can be willing to do that due to the seller finance nature.
So what happens with those maintenance issues you brought up and the seller doesn't fix them or pay for them?
Who? What do you mean?
Like roof repair, foundation repair.
Yeah, so like when I sell it to Kat, and so what I'm saying is, all right, seller, they are A in this scenario. Me or you are B. And then Kat, seller finance buyer, they are C. So what you're going to do is you're going to get seller to allow you to buy it via subject to or seller financing for, whatever dollar amount. And then you are going to seller finance it to seller finance buyer for double dollar amount. And so what's going to happen is C is going to pay that. You are going to get to keep one of that dollar, and then the other dollar is going to go to the bank or the seller, and you keep this difference here. So after I sell it to C, and C needs a new roof, or C needs new foundation, or C needs a new water heater, or C needs a new washer and dryer, or there's a pipe or that breaks, or there's some sewage problems, or February comes around and there's a big freeze and pipes burst, or whatever happens, C is 100% responsible. So if I'm here and C's experiencing those problems and C doesn't fix it, who cares? Just make your payments to me every single month. It's your house. You can do whatever you want with it. But it's C's problem. It's not B's problem or A's problem. Does that make sense?
Do you buy deals all over Texas or just Round Rock also? Do you buy at 70%?
Yes, and yes. So we are open to looking at deals all over the United States or other countries if you got them. We need to buy good deals, like I said. Kat, what's the one thing you should never do? Buy at market value. So we're never buying at market value. We're going to be buying into some sort of value. But if you have a deal for us to look at, or you want to partner on a deal, just DM us or Go to our website, typekeerealestate.com/submit-a-deal. It's a lot, but go to our website. Under investors tab, you can click submit a deal and submit a deal there. We get all the responses. We'd love to do deals with you. Send us a DM, call us, email us, however you want to send the deal to us. Send it over. Let's check it out and see if we can buy some real estate together. Ultimately, that's our goal with you. We just want to buy real estate with you. So if you have some deals or if you need some help doing some creativity to take some deals down, or if you need help in any way at all, just reach out to us, DM us, email us, call us. You can email me at admin@trehomes.com. You can call me at 512-517-1360. You can go to our website, any of these social media channels, and submit a deal. But we would love to buy real estate with all of you. And if you need some help, go ahead. We got more questions.
He just said he had a mansion deal in Dallas, but he couldn't work it because it was worth $1 million and it was selling for 1.8.
Yeah. Well, they probably didn't sell it, right? I'm sure it's still available. But yeah, keep finding deals. We had questions over here, Kat. What are these questions?
What's your opinion on Houston's market?
Love Houston.
Alex loved him. Or his name.
Houston's a great market. All right. So if you need some help getting creative or figuring out ways to do deals right now and how to create some opportunities, we actually have started the entrepreneur community. This is new. This is something that is meant to serve you guys. For the longest time, anybody who wanted to do deals with us, who wanted to learn how to do this type of stuff, they had to come join the real estate brokerage. That's no longer the case. You can absolutely come and join the real estate brokerage and learn everything there and make money in and on real estate and get top of the notch, out of this world training from amazing entrepreneur Dorian Sidney, who runs the Entrepreneur Success Department, and Matt and I. But for all those who don't have real estate licenses or you don't live in Texas, we've started the Entrepreneur Community. Entrepreneur Community, we already got close to like 40 new members. We just launched it. And this is a group of real estate entrepreneurs who are looking to do deals like this. We're already doing deals with each other in the community. You get support from me and Matt. We're training, we're educating, we're walking through deals, we're helping you negotiate. We're your built-in partner. The community is already doing deals with each other. And if you want to learn about the entrepreneur community, send us a DM. You can also take advantage of a limited time offer that we got going on right now. Just go to, it's a long one. Kat, can you put it in the chat? Send us a DM and just say community and we'll get you the info. But we're here to help. We want to grow with you guys. Ultimately, our goal is just to buy real estate with every single one of you. So reach out to us, but you need to get creative. Let's do a quick little recap here. Never buy at market value. Don't buy for appreciation right now. You need some cash flow and get creative. Some ways that you can get creative when negotiating these deals with sellers. And by the way, I mentioned wholesalers. Y'all need to learn this. You need to go out and you need to find creative deals and wholesale them to your buyers. Wholesale them to us. Wholesale them to other investors who need good deals right now. And that's the way that you should adapt as a wholesaler. But seller financing, buying them sub 2, lease purchase contracts. Here's the beautiful thing about creativity is it's the Wild West. You can structure these deals any way that you want to. It doesn't have to look exactly this way. You're not going to have a bank telling you, here's your origination points, here's your interest rate, here's your down payment required, here is your amortization schedule, here is your balloon payment. When you're dealing with banks, they're telling you that, right? They are setting the terms. But here with creativity and with all these different ways to buy deals, You and the seller are creating the terms. Y'all can set it up any way that you want to. You can have $1 monthly mortgage payments. You could have amortization schedule over 1,000 years. You can have a balloon payment in 500 years. You can have a down payment at 0. You can have whatever you want. It's 100% negotiable, and it's whatever you come to terms with the seller. So get creative, adapt, do not fail. Don't be like all the other real estate investors who have gotten out of the game, who couldn't handle the heat. You just need to be creative. You need to learn how to solve these problems, and that's how you're going to get deals done. DM us if you have any deals. DM us if you want to learn more about the community, and we'll see you next week.